Okay. This was an unusual exam period because of July 4th. Okay, so I just want to remind you of that. Ordinarily, what would have happened is, and this is what will happen for the remaining two exams, your exam is on Thursday, so what will happen is on Wednesday the exam will open up right after class just like we did this time, but it will close midnight Thursday. Okay, so you don't have a 5-day window to take the exam. You're going to have to take it within that period, because that way I can come in Friday morning, look at the grades, look at the exam, and we're off and running on the next topic the following Monday. Okay, so that's so just be reminded this was unusual, and I didn't want to make you take the exam either Wednesday or Friday because I knew a lot of you were traveling, or I figured a lot of you were probably traveling, so that's why it was an unusually long time period. Okay, and there this is my first time giving an exam in Canvas, and I learned a couple of things about giving exams in Canvas, so there's going to be some minor differences on the remaining two exams, but I'll tell you about that when we get there. So, other than that, I think that's the only announcements I have for you. So, questions about anything? Questions? Questions? Going once? Twice? Okay. All right, then let's go ahead and continue on with Chapter 5. We started this last time, which was a long time ago, because it was a long time ago, but also because you studied for an exam in between that. So just as a reminder, what we're doing here in Chapter 5 is starting really my favorite topic in finance, and I think really the topic that we don't talk about enough in finance, which is forecasting. Okay? The way the book has Chapter 5 organized, the first half of the chapter, well, I guess you could call it forecasting, but the first half of the chapter is really about how you forecast the financial statements given a sales forecast. Okay, and that's important because the point of that, and you'll see that, we'll see it when we get into it, but the point of that is to try and project any financing needs that you might have. Okay, that's the point of it. All right, so you can do some pre-planning. So that's kind of the first half of the chapter. The second half of the chapter is forecasting sales. Okay, so it's an introduction to forecasting sales. That will be important because we'll continue that conversation in about 2 weeks when we start talking about investments. Okay, because we'll talk about forecasting investments at that time. I have a couple of supplemental pieces of information on there on internal growth rate, sustainable growth rate, so we're going to insert that in there as well. And I also, after we finish going through the forecasting in Chapter 5, I also have some supplemental information on at least a beginning conversation to determine whether or not your forecasts are any good. Okay? And that's the key. To me, that's the key. I've talked to several analysts who forecast sales internally and do all that kind of stuff. I've yet to talk to someone who has a solid methodology to go back and assess whether or not their forecasts were any good. Or, let me put that another way, a solid methodology to determine whether method 1 is better than method 2. Okay, what it seems to me like a lot of them tend to do is kind of fly by the seat of their pants, and they come up with these forecasts, and they either miss or they hit or whatever, and they might adjust something, but there's really no solid plan to determine whether or not their method is any good. And that's what I at least want to introduce you to with these supplementals, with the other piece of supplemental information that I have on there. Okay, so that's kind of what we're doing for the next couple of days. So the first part of this, again, is on forecasting the financials. The key to this is understanding cost behavior. All right. Before the exam, I reminded you of the difference between variable costs and fixed costs, and what are they? I'm not going to do all that stuff again, but what are variable costs?
Variable costs are costs that change in direct proportion relative to the driver and relative change.
Close enough. Costs that change in direct proportion to an underlying driver over a relevant range. And that relevant range part becomes kind of interesting in some of the stuff that we're going to do right here. I reminded you that if you wanted to get really accounting-minded, which we're not going to do, but you could have drivers that are not sales, but for our purposes, and probably for most purposes, the underlying driver that we're talking about is sales. So in other words, variable costs are costs that go up when sales go up and costs that go down when sales go down. Okay? over a relevant range. In the short term, in the relative short term, you will certainly have variable and fixed costs. Okay? But as that relevant range increases, and then theoretically into the limit, all costs would be variable. Okay? So we had that, excuse me, we had that conversation before we took a break for the exam. So let's go ahead and take a look at the first way, which is the book's method, or the method that the book introduces you to for forecasting the financial statements, is called the percentage of sales method. Again, understand the point. Understand the goal of this. Okay, the goal is to determine whether or not you're going to need to arrange for financing. Okay? That's the purpose of this. Okay. So what we're going to do here, the basic idea is as follows. We're going to take all of the accounts on the financials and we're going to break them into two categories. Those that change with sales and those that don't change with sales. Okay? Those accounts that do change with sales, all right, and by the way, this is an assumption, all right, but those that do change with sales, then we will calculate those forecasts as a percentage of sales, hence the name. Right? Those accounts that don't change with sales, then we have to do something else. Okay, whatever that something else is. All right. So let's first take a look. This is an example on Elvis Products. This is an example out of your textbook. So the information is kind of scattered out throughout the spreadsheets here, but it's all out of your textbook. So this is an example of what you can expect on the second exam. All right. So, and I mean, all of the remaining exams in terms of administration are going to be just like the first one and just like the practice exam. So you go in there, you pull up a file that has all of your data on it, and you answer questions. Okay. So it'll all be the same. All right. So we've got this here, income statement. The first task. All right, they're telling you, and I think they changed the years in the book. I didn't update the years, but they tell you that forecasted sales are 4.3 million. Using percentage of sales, prepare a pro forma income and balance sheet for 2010. I'm not going to make you do the. I don't think I am. I don't think I'm going to make you do the statement of cash flows. Again, so I think that's important for the reasons that I gave you before, but I'm not going to torture you with that all semester long. Okay, so we'll focus on the income statement and balance sheet now because really you don't, I mean the statement of cash flow is just the residual of forecasting the income statement and balance sheet. Because once you got those two, then you just, record the changes. So I won't torture you with that again. All right. I am going to, as we're going through this stuff, and those of you who are very good with Excel, by the way, I neglected to mention, I am so sorry, the scores on the exam, I think, like I said, I think the average is about a 79, which was pretty good. But there were two perfect scores on the exam. One of which was Ruth. Congratulations to that. Does the other person care to claim their recognition? James, right? James in the orange shirt got the other perfect score. So excellent work. It's hard to get every single question correct on any given exam. Okay, but we had two on the first one, so nice work, nice work. With this, we're going to forecast sales, and what reminded me of that? I know what reminded me of that is I'm going to slow down a little bit because there were a couple of questions on the first exam where even though more than half the class got them correct, too many people were missing those questions. So I'm going to slow down a little bit with some of my Excel examples. So those of you who are highly advanced in Excel, you need to understand that not everybody is at that level. Okay, so I'm not going to go painfully slow, but I am going to slow down a little bit. All right. Okay. So 2010. Again, the first half of this is given a sales forecast. Forecast the income statement in this case. Again, we're going to go down all we're going to do is go down each account and make a determination. Does that account, are we going to assume that that account varies with sales? If we do, we'll calculate it as a percentage of sales. If not, we won't. Okay? So, cost of goods sold. Is it a safe assumption that that will vary with sales?
Yes.
Okay. Yeah, and we talked about this before the exam. All right. What we're going to do for purposes of the forecast of sales, and really for simplicity purposes, is that we're going to assume cost of goods sales vary with sales. Okay. But like we talked about last time, in the real world, okay, there will be fixed costs in cost of goods sold. All right? So all we're doing is really forecasting a simplified income statement. I mean, if we want to do this in the real world with real money on the line, then, at least if I were doing it, what I would want to do is I would want to drill deeper into this to, at the next level, separate the variable from the fixed costs in there. And then, if you wanted to go to a next level, then you say, well, but not all costs would vary in direct proportion. Because, for example, as you start buying more and more inventory, then you might start getting quantity discounts, which changes that relationship a little bit. Okay? So my point is that what we're doing here is at the simple level, but be advised, graduating finance majors, that if you're doing it in the real world, then you would, I would imagine, you would want to drill into these deeper, more detailed levels. So what we're doing here in, I don't know, 20, 30 minutes, however long it takes us, you might spend a lot of time doing this for real. Okay? In fact, we were having a conversation right before class about the importance of companies meeting earnings estimates. Okay? Well, this is part of the estimate process. Okay? All right, so we're going to assume that cost of goods sold vary with sales. Right? So what we're doing here in the books way, and I keep saying the books way because be reminded this is certainly not the only way to do it. Right? Because what they're going to say is, well, for 2009, cost of goods sold was a little over 84% of sales. Everybody see that?
Mm-hmm.
Okay. For 2008, cost was a little more than 83% of sales.
That's crazy.
With me? Okay. Using the average function, the average of the prior 2 years is 83.9%. And that's what we're going to use to project sales. Yes?
What is the logic behind the 4.3 million? How they coming out with that number?
Well, that's what we're going to talk about in the second half of the chapter.
Okay.
And in my opinion, that's the more interesting part. So
Okay.
I'm with you.
Okay.
Hold that thought for probably till tomorrow.
Okay.
But that's the second half. Not the first half. So given that someone smarter than us forecasted 4.3 million, now what we're trying to do is project, or is to prepare the pro forma statements for the purpose of determining whether or not we're going to need to arrange financing. Okay? All right, so everybody understand how I got the 3.6 million here?
Mm-hmm.
Okay. I hope you also see in this that this is a big assumption. All we're doing is we're taking the average of the last 2 years. Well, why did we stop at 2 years? Why wouldn't we want to go back 3 years, or 5 years, or 10 years? Why annual? Maybe we might want to use semi-annual or quarterly, or what have you. Maybe this isn't even valid because notice we went from 84 down to 83. Well, maybe the next year was 82 and the next year was 81. So if we took an average of that, then I would argue, well, that might not be correct because what we were becoming more efficient, or I'm sorry, becoming less efficient. So the next year, for this year, we probably want to use 85.
Yes.
See what I'm saying?
Mm-hmm.
So before we even go any further, we're already making, in my opinion, huge assumptions. And I'm not saying that, I'm not bad-mouthing the method that we're using, I'm not bad-mouthing the book. My point is to point out the complexity of doing it for real. Okay? That's what everybody does, what the Young Investors Club does, even though they're not projecting this, they're trying to project stock prices. Okay, very complicated.
I have a question.
Yeah.
How did you generate the sales number? What did you use?
Well, right now we're using a given
Assumption.
sales
Oh, given.
forecast.
Okay. Thank you.
Yeah, that's someone, that's the CFO's office came up with this.
Okay.
And we don't tug on Superman's cape, so we say yes, sir, or yes, ma'am, as the case may be, and move on.
You get the second value in there.
The 83?
Yeah.
That's the percentage. Cost of goods sold is 83% of sales for 2008.
The one below it.
That is an average of those two. Other questions?
So do you think, I personally like this way better than like trying to enter a long formula like the book shows?
Well, hold that thought 1 second. Let me answer his question.
So I wanted to say, so you're going back 2 years, right?
Yes.
And the more years you go back, obviously, the less accurate you will be because.
Well, don't want to finish your question. That's a good point, because with forecasting, I mean, I think if you really looked at any forecasting method, the overall process would be a two-step process. The first is look what's happened historically, and the second step is adjust whatever has happened historically for what might change in the future. I mean, that's the overall process. Statistics, you guys all have quant tools. Statistics tells you that the problem with this forecast is our sample size is how many?
2.
2. Okay? No statistician will be happy with that. Okay? So if we wanted to make the statisticians happy,
30
then
something.
we would go back 50 years. So now we at least have a sample size of 50, right? So now we can do all of our econometric stuff. The problem with that, in my view, is this relationship back in the 1950s really indicative of the relationship now? And I would say probably not. I mean, I don't think I have to convince any of you guys of that. Okay? So now, if we wanted to do that, then we could start talking about, well, maybe we can use a weighted average. You know, where we weight more recent years more heavily and then prior years less heavily. But then are you going to use a linear weight? And that's the challenge, but that's also the fun. Okay? And we'll talk more about this in investing. But that's also the fun of it, is to try and figure that out. And when you're actually forecasting and you actually hit it, it's like golf. You know, it's like golf. I stunk at golf. I played it for 2 years. But what hooked me on golf was the very first time that I hit that stupid little egg and it actually did what I wanted it to do. That's what hooked me. You know, when I was off the green and I slid the wedge right under it and rolled it right up next to the cup, that's what hooked me on golf. Okay, kind of like with forecasting. You know, when that first time that you hit it, that's what hooks you. When you take that first trade, I've always said, you know, probably the worst thing that can happen to a trader is to actually make money on your first trade, because then you think you know everything, and sooner or later you will be taught that you do not know everything, and it will probably be an expensive lesson. Okay, so again, yes, with our simplistic approach, yeah, we're just going to take the average of the prior 2 years and move on with life.
Okay.
But all these different approaches are really the point of what I'm going to introduce you to with the supplemental material after Chapter 5. Okay? Tony.
The way I kind of look at forecasting, especially like using like the past 2 years versus like the past like 100 years, it's much easier to forecast, you know, what's going to happen tomorrow versus what's going to happen in a year. So same thing, it's much easier to forecast what's going to happen next year versus forecasting what's going to happen, you know, with 50 years. That's
In your opinion.
in my opinion, and like I know with quant as well, you know, when you're doing like the, you know, the average forecast and stuff, like the ones that are closer are usually, you know, closer to.
Well, and there would be an opposing view to that. And the opposing view would be it's actually easier to forecast what's going to happen in the long run because there can be a lot of friction, there can be a lot of noise in short run prices. So,
Yeah,
you know,
I'm going more like demand forecasting rather than.
Okay, yeah. Well, and that brings up another point, because if we wanted to make the statisticians happy, then we could increase our sample size by looking at our monthly financials. But then we have business cycle issues to deal with, and we have seasonal issues to deal with. Okay, so again, my point is to point out that these are all the variables that you would actually consider in the real world. Okay.
Yep.
Other questions? Other questions? Okay. Well, remind me your question, Tom.
No, I was just saying that I would rather do it like you're doing it here than try and put in a big formula, you know.
Yeah, well, let me show you that big formula. Because the disadvantage of doing it this way is that and if you want it, you know what to expect on the exam now. So, you know, hey, calculate cost of goods sold. So you can calculate it however you like to do it. The disadvantage with this is that it takes up a lot of memory and takes up more space on your spreadsheet. The advantage is that it's easier to read what's going on, at least, you know, in my view, it's easier to read what's going on. So whether you want to do it that way or not is up to you. The book shows another way, which I think is cool. It's doing all those things that are these steps right here. You can do in one fell swoop, which is if you use the average function. All right, so we're going to average this divided by that, comma, and then this divided by that.
Times.
Yeah. Okay. So everybody with me on this step right here? So what this is doing it's calculating that right there. So it's taking these 3 steps and doing it in one. Is everybody with me on that?
Yes.
Okay. And that gives you your 83. And then you need to, of course, multiply that by sales. So that gives you the same answer that we just had a minute ago, right? I hope so.
Yeah.
Yep. And we need to do one more thing, very important. I make this mistake just like everybody else does. This is the vacuum cleaner of time on exams. What do we need to do?
Do an array.
Not an array, but we need to use our absolute reference, because when we copy this down, we want it to be keying off of sales. Okay. So before we forget, let's put in our dollar signs. Okay, that makes life a lot easier and a lot quicker. Okay. So far, so good? Okay. All right, then that gets us down to gross profit. Selling and G&A expenses. What's G&A stand for? I'm glad I asked. General administrative expenses, okay? Would it be safe to assume that they vary with sales? Again, we're making some leaps here. Okay. Yeah, they probably vary with sales. The more sales we have, we're going to have to hire more people, salaries go up, et cetera, et cetera. Okay. So, since we did what we did right here, all we need to do is copy that down. I'll go ahead and get this out of the way, because when you have this, if you're not using this any longer and you have it lingering around, then when you get all the way over here to the balance sheet and something isn't, you know, you're 100 calculations into this and something's not working right and you're going back, you're wondering what this is doing. Okay, so I get rid of that. Are fixed expenses variable expenses? If you miss that on the exam, I'll cry. Not in front of you, but I will. Okay. All right, what about depreciation? Is that going to vary with sales? Keeping in mind that really the book's approach is a shorter term approach, which is fine. Okay? It's a shorter term approach. The supplemental material that I've given you is actually more of an intermediate and a long-term approach. Okay? So in the short term, and when I say short term, we'll say a year. Depreciation vary with sales?
No.
No. Okay? This is where we need to do something else. Okay? Well, in the information in your book, they tell you, they give you all of the capital budgeting information. They bought, I think, $50,000 worth of property, plant, and equipment for the year, and they simply tell you that depreciation went up by $5,000, if I remember correctly. So our depreciation would be 25. Everybody good with that? Again, we're going down each account line by line. If it varies with sales, we'll put in our average function. If it doesn't, then we will do something else.
So we change it or not?
So far, so good? How do I get what? They give it to you. They tell you that they bought $50,000 in PP&E, has a useful life of 10 years, and therefore depreciation went up by $5,000. So again, I'm not going to turn it into accounting class and make you calculate all that stuff. Yeah. The accounting department told us that.
Oh, okay. And I was just wondering if we should like make that into a formula, like put it, have a reference, so.
Yeah, if on the exam, yeah, all right. Tommy's right, he wants to do good practice of spreadsheet here, so
I mean, if
20,000.
we're gonna change it, like it's
All right,
gonna
I'm
depreciate.
You're right, 5,000 over here, so 25. You're right. And for that matter, if I had a forecasted sales down here, then you'd want to link that to here.
Right, yeah, okay.
You're right. Yeah.
Can you quickly go back to the selling and general administrative expenses right there? Yeah, there's the average, oh, that was that formula that you
Yeah,
used.
all I did for that was to copy this down.
Okay, well, I didn't use that originally. That, I used what you gave us, like our little sheet to the side.
Well, that's fine.
Okay.
Yeah, if you want to do that, that's fine, but you can see how you're uglying up your spreadsheet,
Right.
which, I mean, you know, for a small spreadsheet like this, it's not going to be a big deal.
Okay.
Bigger spreadsheets, it does become a big deal.
No worries. You just did it fast.
I would say either do it one way or the other, but not both.
Yeah, get,
So don't do
come.
this there and then something else over here.
Okay.
Be consistent. Other questions? Other questions? Okay. All right, what about interest? Vary with sales? Interest vary with sales? Of course not. Okay, that's part of our capital structure. All right, they tell you that you're paying 11.7% interest on long-term debt. Okay, that's what's in the information there, and that is on. I believe that rate. Before I do it, let me double check it. That's on. On the pro forma. Okay. All right. So we're paying 11.7%, and they also tell you that we're borrowing. Time out. Oh, right. Okay. We're paying 11% on our long-term debt. So 0.11 times the 4261. Oh, we're good. All right. Excel challenge. Notice that there's an apostrophe up here. Okay. That means Excel thinks that what I'm putting in there is a label, not a number. That's why it keeps hanging up on me. Okay? So it thinks I'm trying to put in a label. So I need to tell it that it's a number by either putting in a plus or the equal sign. And I think in Excel, in Mac, you have to use an equal sign. I believe that's correct. I've had a little bit of trouble with that in Mac, and I believe it's because you have to put in an equal sign, those of you who are Mac users. So 11.7 times our financing, which is 420, which gives interest expense of 49,680, right? Okay. So again, there's in the information, all right, they're simply telling us, hey, our cost of capital, our cost of debt capital is 11.7%. Okay, this is what we have, and this is actually, if you read through the book, they talk about iterations, and this is a potential problem because remember that the point of this is to determine if we're going to have to raise any additional funds. Well, if we're going to raise additional funds, then that's going to change our interest. Okay, so you can actually set up Excel to do iterations, so it's like a circular calculation. And you can actually set up Excel to go through scenarios, to go through iterations to come up with the exact solution. I'm not going to do that to you on the exam, but when you read through the chapter, that's what they're talking about right there. Okay? All right, so questions about interest. That was a long-winded discussion of something that's pretty simple. Question? Okay. All right. So we got earnings before taxes. Taxes, we will continue with our simplifying assumption. The tax rate on this, I think, is 40%. So we will just go ahead and simplify taxes as 40% of earnings before taxes, being reminded you guys all know that that is not how taxes are calculated. We would actually need to get that from the tax department. Okay. All right, and that gives us forecasted net income. Yeah.
Could you go back to selling and?
Yep. Yeah, with these are both, we're assuming that they're variable costs. So these are just a percentage of sales based on the averages for the prior 2 years.
So you averaging out sales with those
Yeah. So for cost of goods sold, again, so these are the cost of goods sold was 84 and 83% of sales, and selling in G&A was,
Oh, okay.
yeah, that's right. So we're averaging those two and taking that average and multiplying it by this, which is what that big function that Tommy doesn't like is doing right there. Okay. And that's also on the solutions that I have under the in-class examples. That's what I'm explaining right down here. Okay. So what I just did over here, and everything I just showed you, is what I explained right down here. Okay. So this is the solution that I have posted online. Questions about any of that? Questions so far? Okay, formatting note. This is actually pretty cool, not that I ever use it, but notice, just for example, our sales are 4.3 million, which is a lot of zeros. Well, in the solution, notice that they're presenting the numbers in thousands. Even though, if you look in this, even though it's 43 million, okay, or excuse me, 4.3 million, it's being presented as, and actually, I guess that would be hundreds, wouldn't it? Okay. The way you do that is if you right-click and go to Format, down here in the Custom section, you do that by adding commas behind the zeros. Okay. So if you just use the format that's there, notice that that will be presented as 4.3 million. Don't ask me why they chose commas to do this, but if you add in one comma, then it will be presented that way. Add in 2 commas, it will be presented as 4.3, so this would be in millions. And then, of course, well, yeah, this is in thousands they have in. But if you did it this way, then right up here you would say in millions. Okay? Very common on when you're reading, when you're analyzing financial statements. Very common. It cleans things up quite a bit.
But it doesn't affect.
No way for me to really test you on it. I mean, I guess if you really want, I can say, how do you format this? And give you a bunch of choices as answer choices, but I can't bring myself to do that to a class full of seniors. I'm sorry?
No, I was saying it doesn't affect your calculation.
No, it's still, yeah, notice in the cell, it's still 4.3 million.
Okay.
It's just the way it's presented. All right, so any questions about that? I'm being sincere. Okay, so let's jump over to the balance sheet. So now, yeah.
How do you skip from sheet to sheet? Is there a way to go back and forth?
I'm just clicking on the bottom, probably like a control tab or something, you may know.
It was control shift, like page up and page down.
Control shift. No.
Or control and page up, page down. I can't remember. I just know
Yeah.
how to do it.
If you hold down control and do page up, page down.
Oh, okay. Thank you.
Yeah, good tip. Other questions? Other questions? Okay. So now we're going to do the same approach with the balance sheet. Okay, so we just forecasted the income statement. So of course you're given all of that exam question. What's your forecasted income? What's your forecasted operating income, et cetera, et cetera. All right, over here on the balance sheet, we're going to do the same thing. So starting with cash, kind of a tricky question. Would we expect cash to vary with sales?
Yes.
Yeah, we would in one sense, but what the book is arguing, and I wouldn't disagree with this, is that even though as sales go up, for example, and our cash goes up, what are we then going to do?
Reinvest it.
Well, yeah, I like the word reinvest better than spend, but we're going to do something with it. Okay, reinvest it, pay down some debt, do something with it. So we probably have a target cash level that we will maintain. Okay. Again, this is going to vary by company. Okay. I used to have one client. And I don't know why this always stuck out at me. Every week they would generate what they called a cash requirements report, and they did that every Monday morning. And what that did was it told them how much cash they need in the bank on Friday to pay their bills. And this was a publicly traded company. This is not Joe's hot dog stand. This is a big company. Okay? And they did that every single week, and that's how they managed their cash. Okay? So we could have a big discussion about how to manage cash, and Steve Jobs certainly wouldn't have agreed with this. But what the book advocates, and I don't have a problem with this as one method, is that we probably have a target cash level. Okay? So what we're going to assume is that cash will not vary with sales, because if we have excess cash, then we're going to do something with that cash. If we don't have enough cash, then we're going to have to raise cash, which is really, again, the point of all this. Okay? Yeah.
But isn't it changing every year? Like 2008, you have 57,000. 2009, you got 52,000. And then 2010, you're assuming again. That's a big assumption. That's a huge.
Yeah, I mean, cash is almost 11% different from one period to the next.
And again,
Yeah,
if you
I would
go
agree.
if you go look at your sales from the previous year compared to the sales in 2008 and 2009 to your cash.
Yeah, but it would depend on your corporate policy. Because you guys know from some of your prior courses that actually looking at cash balances is one way to infer insider information. Mm-hmm. So if you see cash balances going up over time, then that's indicative of maybe they got something cooking. Maybe they're looking at purchasing something. Cash going down Maybe that's a sign of financial distress. So I'm not disagreeing with you, but all we're saying is that because it's going to be unique to every company, then we're just going to assume they would have a target cash level. So whatever it was last year.
Again, so what you're saying is that the CEO saying we need 52,000.
Yeah.
Okay.
Well, and yeah,
Just
that's
like
what
this
I was
stuff.
telling you, is that this company that I used to work with, that's what they did every Monday morning. First thing they came in, they generated this report and told the CFO, hey, we need 52,000 by the end of the week to make payroll.
I see. Okay. Now that makes sense.
Other questions? So far, so good? Okay. What about accounts receivable? Vary with sales? Yeah. Yeah. Okay. So we'll do the same average trick here. So this would be 2009 receivables divided by 2009 sales. 2008 receivables divided by 2008 sales, if I can get it in correctly. Hang on. Average. Divided by 2009 sales, comma, 2008 receivables, which would be D6, divided by 2008 sales, times our projected sales. And that does not pass the reasonableness test. So what did I do wrong there?
It looks like you have balance sheet though.
That's what I did wrong.
Something.
It's that right there. We can do it this way, we've got to find out. Like I say, when you make mistakes, this is the vacuum cleaner of time. All right, average of accounts receivable divided by sales, right?
Mm-hmm.
Comma, keep me honest here. Accounts receivable for the prior year
Picking up the wrong number.
divided by sales. And then we're going to multiply that by sales for this year. That definitely doesn't pass.
You got a comment between balance sheet D6 and income statement D5 and 7 divisions.
Thank you. All right. Got it. All right, everybody with me? So a little bit of Excel trick there, but we're doing the exact same calculation with this that we did with cost of goods sold and with operating expenses. It's the exact same calculation. Okay. So everybody with me on that?
Mm-hmm.
All right, let's make sure we lock things because we're locking this stuff. That's what we're doing, right? I think so. Okay. All right, what about inventory? Now that we got all that figured out, what about inventory? It's going to vary with sales?
Yes.
Yep. So we'll copy that down. So that gives us our current assets. So far, so good?
Yes.
Okay. Property, plant, and equipment, is that going to vary with sales?
No.
No, not in the short term. In the long term it will, but not in the short term. Okay? So this is where we would need to go to our capital budgeting policies. And like I told you before, I believe they're assuming that they purchased 50,000, you know, 50,000 in PP&E. So that plus 50, 1, 2, 3. Yes, Tommy, you'd have a formula that is on there somewhere. So that is simply what we're told. So that's part of the information. Accumulated depreciation. What do we do with that? Is that going to vary with sales?
No.
No. So will it just be 166,200? No, because
You have to add this year's.
so beginning depreciation plus our depreciation expense. Like I said, beginning depreciation plus depreciation expense will give us our ending. Notice that we're ignoring sales of depreciation and all that kind of stuff. So there are more exam questions for you. What are your projected current assets? Long-term assets, total assets. Yes. Yeah, we did assume inventory would vary. So far, so good? Okay. All right, and the last piece to this is to forecast our liabilities and equity. All right, and what we're going to do here is we're going to break these accounts into two groups. That is what they call spontaneous financing versus discretionary financing. Okay? Spontaneous versus discretionary. Okay? Spontaneous financing is going to be financing that's relatively easy to get. And we will assume that that varies with sales. In other words, financing that's going to arise in our ordinary course of business. Does that phrase sound familiar? Mm-hmm. Yeah, we talked about that with the cash flow statement. Okay. So that's spontaneous financing. Discretionary financing, on the other hand, is financing that's going to be hard to get. In other words, primarily long-term debt and new stock issue. Okay. With our discretionary financing, for example, spontaneous, for example, accounts payable. Right? Well, you guys all know that accounts payable represents what we owe our suppliers. Well, we're calling that spontaneous because if our sales are growing exponentially, okay, because those sales are growing exponentially, so too is our inventory. Okay? We need to finance that inventory. Okay? We're doing that through accounts payable. Right? Well, we're calling this spontaneous because probably all we need to do is pick up the phone and call our supplier and say, hey, Jane, my sales are going nuts over here. Can you increase my line of credit? And they say, yeah, no problem. And we're done. If you're going to do a new bond issue, can you do that? No. If you're going to issue stock, can you do that? No. It's a big, long process. Okay? So that's what we're doing with the liabilities and equity, breaking them into spontaneous versus discretionary financing. The point of all this is to forecast our discretionary financing. That's the point of all this. So is that going to be an exam question? Of course it is. Of course it is. Okay, so I already told you that accounts payable are going to be spontaneous financing. We went through the pain of that formula up here, so all we have to do is copy it down here. Right? What about short-term notes payable? We had this conversation with the statement of cash flow. Where would short-term notes payable go on the statement of cash flow? In the financing section, as opposed to the operating section. Okay? So this is an example of where it's not just as easy as picking up the phone. Now, granted, it's going to be bigger than a big bond issue or a stock issue, but it's probably not going to be as simple as picking up the phone. So this will be part of our discretionary financing. This is part of what we're forecasting. So for the moment, all we're going to do is put in what we did last year. And I'm going to flag it just to make sure it stands out. Everybody with me? Mm-hmm. Okay. Other current liabilities. Spontaneous? Yeah, we'll say yeah. And we already determined that long-term debt is discretionary. As is that, but not retained earnings. I'm filling in the holes that weren't there. So we've got our spontaneous here with accounts payable and current liabilities, so they're varying with sales. Short-term notes, long-term debt, and stock issue is what we're forecasting. That's the financing that we're forecasting. So the only account left is retained earnings, and what are we going to do there? How are we going to forecast retained earnings?
Net income
Okay. So how about beginning retained earnings
plus net income.
plus our forecasted net income? This is where that iteration comes into play. Because when we change our financing, that's going to change our interest expense, which changes our net income, which changes retained earnings, which changes our financing, which changes interest. That's where all that comes into play. I'm not going to make you do that on the exam, but they talk about that in the book. Okay? So we got beginning retained earnings plus net income. And they also tell you that they paid, I believe it was $20,000 in dividends, is that right? 20,000 in dividends?
But some of them have consistent percentages that they like to do, right? So would you use those as projected?
I'm sorry, hang on 1 second. Was it 20,000 in dividends? B19. 22,000. So they told us that they paid 22,000 in dividends that year, so that was a gift. Okay, and I'm sorry, what were you asking?
So the reason why I was asking is because you hear that, companies have their dividend policies. Do they always have like, well, not always, but do they try to do a targeted percentage? How do you know how much you're going to pay if it hasn't happened yet?
What do you guys think? Philip?
I'm sorry, I had a.
Oh, okay, hold on 1 second. Dividend policy, what do companies do?
Try to keep it stable.
Okay. So try to not change it from year to year?
No, try to have stable growth.
A little.
Okay.
Okay.
I think that would be a fair across the board statement. There are going to be, companies that vary in their dividend policy, but I think a fair, painting with a broad paintbrush, so to speak, would be that they would try and have dividends with a steady growth. Because one of the interpretations of the dividend policy is the financial health of the business,
Right.
which is to say the more dividends they pay, the more profitability they expect in the future. Not always the case, but that's, if you want to do something interesting sometime, on these stock searches where you go on there and search stocks for various criteria, search a stock by payout ratio and look for maximum payout ratio. I'll just dangle that carrot in front of you. Do that sometime. Very interesting.
I just noticed that they don't balance, is that a concern?
That's the point of this.
Okay.
So we make sure they don't balance by the correct amount. Other questions before we do that? So everybody understand how we forecasted all of these accounts right here. Accounts payable, that is spontaneous financing, so we're assuming that that varies with sales. So we're doing the same thing that we did with all the others. Average, percentage of sales. Correct. Same for these two here, which on the solution, which I'll just go ahead and jump to, is what I have right here. Okay, so our accounts payable and current liabilities we're assuming varies with sales. Okay. Other questions about how we got these accounts? Okay, so again, as Phil pointed out, notice that the balance sheet doesn't balance. And the reason is because we kept these accounts constant, because this is what we're forecasting. All right? So as a result of all this, what we're projecting is almost 1.8 million in assets. We have 1.77 in financing, so even though it's a small number, well, actually this is in thousands, this is probably 22 million, but in any case, what we're projecting is that we're going to need to raise some money to support the asset growth. Okay, so this is the point right here. Okay. Now, how we raise it is your capital structure decision. Are we seeking an optimal capital structure? Are we going to simply borrow to capacity? Do we want to lower the risk of the business? All of those would be good senior level questions extending off of this. Okay? But regardless, the point is we need to raise some money to support the asset growth. Okay? And if we're projecting these out a year, what that tells us is we've got a year figured out, loosely speaking. And again, that's in a more polished version. That's what I have right over here. Okay, so discretionary financing need. So this is a deficit indicating that we're going to have to raise money. Notice Excel trick. I showed you guys this. Before. I'm using the if function to put in to make it very readable, whether we have a deficit, surplus, or whether it's balanced. Note, if you want to get really Excel-headed about this, notice that I'm using nested if statements in here to do that. One of those things I can't really easily test you on, but a good Excel trick nonetheless. Makes it very readable. Yep.
Is there a case where we could have assets be less than liabilities and equity?
Yeah, and in which case we have a financing surplus. Okay. And that's actually what we're doing with my supplemental information that we'll get to tomorrow. Okay. Other questions? Pretty easy. Pretty simple. You know, a few little Excel challenges in there. You know, learning some new Excel functions, jumping back and forth in between sheets. But once you get all that taken care of, it's pretty simple. So again, what you'll see on the in class on the Canvas is this and that. Okay. Tomorrow we will start. So all of this was short-term forecasting. Okay. So where we'll pick up tomorrow is with long-term forecasting. That's the internal growth rate and sustainable